One of the great things about being passionate about investing is you get to see a lot of different people's portfolios and how they really decide to manage their own money. And me personally, I see a lot of different people's portfolios for when they ask me for advice or even working in a professional setting in wealth management. I was able to see a lot of portfolios, and I really started to see some common trends in how people organize their portfolios. And so today, what I've gone ahead and done is I've taken a few of the most common types of portfolios you'll actively see, and I'll be giving my own thoughts and advice in terms of what I would do if somebody came to me and said, "Hey, I need some investing advice, and I know you're really passionate about this, and you're going to school for this, and you're trying to have a career in this, so what are some things I should be mindful of?" So, without further ado, let's get into today's video. So, as you can see on screen, I have our first portfolio. Now, what I've gone ahead and done is categorize this as the speculative portfolio. There's going to be some generalizations in here you'll see as we go through. That's because everybody's portfolio tends to be a little bit different, but you tend to see some like common trends almost. So for this speculative one, let's talk about the type of investor you're typically going to see that has one of these speculative portfolios. The first thing that jumps to mind for me is someone who's first starting out investing. So we recently had an investment club meeting, and I actually hosted a roast my portfolio, kind of similar to how Reddit does a roast my resume. And I saw a lot of these types of portfolios, and it makes sense. It's people who are first starting out investing, who are young, so they have really long time horizons, who maybe they understand a little bit about risk and they want to take that on, or maybe they're just trying to make the most amount of money possible this instant because they're younger, they don't have as good a careers, they haven't been working as long, etc., etc. So, as we look at the positions, don't hold too much weight into the names or the different things I actually have in the portfolio as much. It's just this is a general breakdown of what a concentrated, highly speculative portfolio would look like. So, for this example, I've gone ahead and put 50% allocation into Bitcoin, a 10% allocation into Nvidia, 10% into Palantir, 10% into Solana, or also could be Ethereum in this spot. You'll see that a lot, and then 20% into Tesla. Now, again, don't focus too much on the names. Those aren't necessarily the specific parts. What I was really trying to capture here is this type of portfolio is going to feature a lot of the names that are, again, in the front of the Yahoo Finance, typically, Wall Street Journal. They're going to be what people are making videos on. Think big, exciting tech. And a lot of times these are going to be, even if it's not intentional, well, it's intentional, but like not really thinking it through with all of the background and education, highly concentrated positions in this type of thing. Now, when I see a portfolio like this, one of the first things I think about is volatility. This is going to be a bumpy ride. And for some people, I think if you understand volatility, that can actually be a good thing, as this can give you a lot more buying opportunities inside of your portfolio. But for a lot of people, this can also be very tempting to sell. I know understanding the Bitcoin thesis and a lot of the things that go into these crypto assets, and then of course the Nvidias, Palantirs, and Teslas. I understand people might be going into these positions thinking, oh, these are going to be stables in my portfolio for a long time, but there's a difference between saying something and actively keeping that as a part of your portfolio. For a lot of these people, it really just takes one market correction to actually test their conviction. Like, this is a portfolio that is very much set up for a testing of conviction. What will you do? And a lot of people, they don't just have it in them to withstand their portfolio getting hit with a 30% drop. If they see something like that, they're going to immediately panic and sell. So that's a worry I have when I see a portfolio using this type of allocation. Another thing I'm worried about is hype. Now, when I say hype, I don't just mean what's doing good and that's evil because I'm a value investor. And yes, there will definitely be some things that I look at and I have a different opinion because I'm a value investor, but I'm open-minded to the fact that people invest differently and have different investment goals. What I'm more worried about is the cost basis at which you got these highly hyped securities. Because, again, when we get back to the volatility portion, if you're buying at all-time highs on these things, and a lot of the times it's not that, oh, 5 years ago I really liked Nvidia as a company and I saw the potential. It's more like, oh, with generative AI, I jumped on the bandwagon with NVIDIA, and that's a good setup to not fully understand the fundamentals and what you actually own as a business share in NVIDIA. So I worry a little bit about the cost basis and the understanding there. And then, of course, the potential of panic I've already touched on. So let's say I had a client who came to me and said, Torin, can you please help me? And this is what my current portfolio looks like. What would I look for? Well, naturally, first things first, diversification. I don't want to sound like an old grandpa or anything, but having as big a concentrations in some of these positions as you do is not going to necessarily set you up for the future. Yes, it's really exciting to think about all the wonderful technologies that are coming around, and I would be really intrigued to see some of the crypto assets actually play a bigger role, and we're starting to see a little bit of these utility cases come up. But that being said, when you surround yourself in an echo chamber with these opinions, if they're wrong, which again, there is a potential they can be wrong. Again, I'll be fully upfront and transparent. I have some allocation towards Bitcoin in my portfolio, but I would not make it a figure in my portfolio that if I lost all of it would set me back for a really long time. Or if there was a much better one that came on the scene that really built on what Bitcoin is, then I would not necessarily lose a significant chunk of my assets. So have that in mind. Again, with the single stock selection that you're typically going to see, is NVIDIA the best name in AI? I'm just throwing that out there. It's something, I'll be honest again, NVIDIA is a company I have owned previously. I don't have any share in NVIDIA right now, but I have owned it previously. Are there better names you can get at a better price right now? Again, same with the Palantirs, Teslas, those types of things. Yes, it's fun to speculate on things, but you really need to look at the competitive landscape. Again, NVIDIA is a company that if I see, I'm not going to be like, hey, you need to sell that immediately. But I think there's definitely, it's fair to question, hey, is this really, really expensive now looking in that space? Should we be looking at a Taiwan Semiconductors instead? Just throwing that out there. Or like Tesla, do we think, how much is robo-taxi built into this valuation you're putting on Tesla? When we consider also the existence of Waymo and the competition that's going to go there. Again, just some things to keep in mind. So really what I think that this person definitely needs, and I'll touch on this in my ideal portfolio at the end of the video, is a solid core. It's okay to have speculative positions. I know, I'm throwing that out there. It's wild, it's crazy. But you need to have something that actually sets you up long term that you can feel confident in, like an S&P 500 index fund. I know, boo. But still, you need something that can be a solid, safe choice. And that way, that can be a big part of your portfolio. And then you can still have fun with these highly speculative things that you're hoping definitely pay off because you like the idea of having something that can't be printed as a digital currency. That's awesome. And then also, the final thing, have a portfolio you can actually sleep at night with. A lot of people will come into this with their speculative portfolio and they're constantly monitoring things all the time, looking at charts, etc. That is not investing done right. Your investing strategy shouldn't be something you're glued to the screen for, because if you are glued to the screen, you're more likely to act, and that is the worst thing you can do in investing. Okay, moving on to the next type of portfolio we have. This is what I've named the I've held these forever holdings. So, the typical investor you're going to see with this type of portfolio that I am all too familiar with is the much older crowd. So we've gone from very beginner investors to probably retired towards the end of their life cycles, and this is their portfolio that they've held on to forever. Working in wealth management in an internship, I saw a significant quantity of these portfolios. And these are just some of my initial thoughts as to what you might see. So typically, what I saw is that you're going to see probably one or two positions, such as an Apple or a Microsoft or a Google, or some people's portfolios, it was even United Healthcare, despite the fact they're dying this year. You're going to see a couple of those that have just become significant concentrations. Actually, 25% and 20% on this might not even do it justice. You would be very surprised to see how many portfolios of people who you'd think on paper would have a significantly more diverse portfolio than they actually do have like a 50% allocation into Apple or Microsoft because they refuse to sell any of it. And it's a two-edged sword, because I'll bring up why this can actually be a problem, because typically in these portfolios what you'll also see is a lot of has-been names that are in the end of their life cycle. I think a lot of people don't fully understand the idea of the business life cycle. There is going to come a day where the company is going to die. I think that's something we all need to come to terms with. It's not going to necessarily be tomorrow. They're not necessarily going to be an Enron situation, but there are going to be companies that are going to be at the top of the peak, and then in 25 years, they're going to be reduced to almost nothing. It's just natural. It's going to happen, and that is okay. But what's not okay is having a position and holding it and getting this massive gain, and then just not paying attention to it, and then you'll see some of the losses on these things are now like 70%, and these would have been market darlings only 20 years ago or whatever. So again, it is good to hold these forever and let them compound, not the bad ones, but it is good to, like, when I say forever, like a really long time, like a lot longer than the typical holding period is, which is now a matter of months, years and years, you should be partnering with your firms in your portfolio. But you also do need to monitor more than never in your life. There's a great area in between. I'm on Yahoo Finance all day, and FinViz, and TradingView, and then on the opposite side, I don't look at my investments ever. There is a sweet middle spot you can achieve, and you definitely should achieve, because damn it, Doris, your portfolio back 35 years ago was going to be incredible. Like, this would have been a train, and now you've just held on to these companies that are no longer doing anything, like Tupperware. You're like, what are we doing here? So again, here's some of my thoughts. A lot of the times what you'll see is these are the types of portfolios that are very, very targeted in specific areas, like near where they're around. So one of the things that kind of upset me when I looked at some of these was there was zero allocation to international whatsoever. And I get it. The United States has absolutely smashed international firms for a long time, but there's no guarantee that that's going to be the layout forever if we're seeing the death of globalism. So, and I'm not saying we are, but again, you want to actually have a protected portfolio, so have some allocation in international firms if you're going to be taking on this strategy. Additionally, a lot of these portfolios, again, we mentioned that they might have 2 or 3 big size positions in their portfolio, and then the rest of them are just like these small little dinky 1% things that like won't contribute whatsoever. Like, if that company just absolutely has a great year, you're hardly going to feel it in your portfolio because you have such a small allocation to it. And these are the types of things you don't really have any conviction in, which, in my personal opinion, if you don't have great conviction in a company, you shouldn't own its shares whatsoever. Then, again, we're going to have many losers that are at the end of their business life cycle, as I talked about earlier. And another thing I saw with a lot of these types of portfolios is they actually really, really underperformed. Even so, in this example, I've gone ahead and taken a lot of companies out of S&P 500. And typically what you'll see is these portfolios don't actually hold up in the long run to the actual weighting of the S&P 500, despite the fact they're only picking companies in the S&P 500. So Why risk it if you don't have good stock selection or allocation? Just invest in the S&P 500. If you want to invest solely in US large cap companies, there are plenty of ETFs that are very, very, very low expense that have proper weighting and actually weight it so if companies are doing really good, they'll take up a bigger position, and if companies suck, they'll get dropped from the index or take up smaller positions. So these are the types of things that you want. Also, there's usually not enough firms even in these portfolios to eliminate what we would call firm specific risk, especially if you have 25%, 20%, or as I mentioned earlier, up to 50% allocations in some of these companies. Now, what do I mean by firm specific risk? A lot of times when we hear about risk in portfolios, it gets broken down into two separate categories, that being your firm specific risk and your market risk. Now, the market risk is just the risk the stock market is going to go down. It's pretty simple. It's something you can't get rid of if you have any allocation in stocks, such as if COVID-19 happens, it's going to kill a lot of the market for that year. Your firm specific is how reliant you are on the actual individual companies in your portfolio. So if I had one stock and that was the entirety of my portfolio was Apple, I would be dependent on Apple's stock performance as to how my portfolio was going to do. Versus if you have around 40, you virtually eliminate this idea of firm-specific risk, or at least it's such a small amount it doesn't really matter. But a lot of the times they don't actually eliminate all of this, despite having their primary focus be having a diverse portfolio. So the last thing I'll say, again, you're trying to do basically an ETF without just investing in an ETF. How many of these companies do you actually know well and can explain? If you have 20 companies, you probably can't explain the investment thesis on all of them. Well, I mean, unless you're an investment professional or you have a significant quantity of time on your hands, you can't really know that many companies to the point that you can have good concentrations and high conviction bets on companies. So for the people that fall into this type of crowd, just again, as a very general advice here, just simply invest in ETFs. If you're going to only invest in U.S. firms, which again, don't admit, you should have some allocation to other areas and other regions. But if you're only going to invest in large cap U.S. companies, do it through an ETF. Next, we have what I would consider our all hail dividends portfolio. This is a portfolio that has really been taking off, and I see a lot of content creators in the finance and investment space promote this, and it makes a lot of sense because everyone loves dividends. Again, sometimes you don't if you're in a really high tax bracket, but for the most part, everyone loves dividends, and for good reason. We see that companies that are committed to actively paying a dividend do better on average than companies that don't. And I like seeing that management prioritizes giving back to shareholders. But typically, when we see these types of portfolios, they prioritize the wrong thing. They solely look at what's going to pay the largest dividend. And typically what we also see is that companies that pay these extreme dividends, they aren't sustainable, they can't keep paying these ridiculously high dividends, and they're sacrificing all their growth opportunities to do so. And sometimes in extreme cases, like I've seen before in people's portfolios, they're actually paying out significantly more than their company's earning, which I just absolutely hate to see. The companies that are okay doing that are content not growing. And you will actively see companies that are content not growing and just trying to return money. Because it makes sense. If you are an executive and you have access to getting stock shares of your publicly traded company, right? And you think that you don't have a lot of growth opportunities if you were to deploy capital. What is the easiest way for you to boost your payday? Pay a fat dividend and just take the money that your company's making and put it directly into your pocket. That's like why we see this happen. And this is something you'll see in a lot of family-owned firms in particular. Now, again, not all companies that pay these very, very high dividends are unsustainable, are bad, are poorly managed companies. But there needs to be an emphasis on prioritizing companies that pay sustainable dividends. Also, another thing you'll see with this type of portfolio is a lot of the people who actually have enough money to do this, they aren't trying at all to reinvest any of the dividends, because obviously you won't want to reinvest dividends in companies that stock prices falling off a cliff at the cost of, hey, we want to throw as much money as possible to our shareholders. But again, what I would do to try and fix this portfolio: prioritize sustainable dividend paying companies with low payout ratios, so you're kind of getting the best of both worlds, because those are the types of companies that will still have growth potential, and they're also going to do really well because they make enough money to commit to paying you a dividend. So let it be an accretive thing to shareholders and not something that actually hurts them in the long run, but they can't see because they're too busy getting their lollipop now, as opposed to waiting 5 minutes and getting 2 lollipops. And then the last thing I'll say on this type of portfolio is a lot of time you're missing the growth opportunities. When we actually look at factors, growth over the past 20 years is crushing it. Same with momentum. And the types of companies you're going to pick up in these portfolios aren't going to necessarily do that. Like, why would you have a company that they're trading it just flat 4 years? And I see this all the time. They are trading it absolutely flat. You are basically just only sitting there for like a 4% dividend yield. Just buy a CD at that point and pick up 25 basis points. Like, there's no need to do that. Okay, the last thing. I promised I would go over this, my ideal portfolio. Now, if you've watched a video of mine before, you probably know I'm a bit of a core satellite portfolio glazer. And for good reason, I believe. But really quickly, we'll go into what a core satellite is and what I think it's when it's done like at its finest. So for your core, you're going to have a broad index fund or ETF. For me, I like the Vanguard S&P 500. Also, your core, just a side note that I'll touch on a little bit later, but your core can have multiple ETFs if you want. Just throwing that out there. And then what I like to do is make these single stocks, but again, you can make these ETFs, is I like to have 6 to 8 high quality concentrated bets on single stocks. These are companies that I put a tremendous amount of research in before they actually make it into my portfolio, and that's why they are given such high concentrations, because these are companies I feel confident in. Now, the core satellite portfolio, I'm going to throw it out there, isn't perfect, because honestly, there's not a portfolio that is perfect for everyone. So I'll address some of the risks. You will be taking on firm-specific risk. Again, if you go the single stock route, you will be taking on firm-specific risk. This can be a good thing or a bad thing depending on your selection. Additionally, requires great selection for the satellites. If you select only underperforming stocks, then your portfolio performance is going to be dragged down by these. It may limit your upside if you are a really, really good single stock picker. And this makes sense because the S&P 500 is basically your big old safety net and an egg in your nest. And so if you are really, really good at picking single stocks, it will drag your performance down a little bit, but the trade-off to that is it also severely limits your downside because your largest allocation is in a broad index. And then finally, it does actually take security selection skill. Now, what I mean by this is you probably need to have some level of education. Not necessarily, oh, I need a college degree, but pick up The Intelligent Investor by Benjamin Graham. Watch actual quality YouTube videos on security analysis. You don't necessarily need to be the greatest at discount cash flow models or anything like that, but you do need to have some knowledge in looking through a balance sheet, looking through a cash flow statement, looking at an income statement, looking through 10Ks. I'll give a personal example on 10Ks. There was this company I was valuing recently, right? And I went to their risks. Now, a lot of people, they just skim over the risks in a 10K. And this can be really, really bad. Because one of the first risks I saw that I know a lot of people, if they never opened up a 10K, would have never seen this was, and I'm going to paraphrase this because I'm not going to get the wording exactly right, but our number one product makes up the vast majority of our sales. Also, it's been decreasing in sales. That right there is a, oh, throw this in the don't touch and don't look at pile. But for a lot of people who don't actually even know about annual reports or would know where to look for something like that, they might completely miss that and invest in a losing company. So again, understand what you know. Try and come to terms with the fact that you probably know a lot less than you think you do. I probably know a lot less than I think I do, and I also know how much time I spend researching and learning about that. And it's something that you need to come to terms with and be okay. And then for some of our potential fixes, if you're really worried about the single stock selection, you can use ETFs that'll hit target areas that aren't in your core. And then additionally, make sure your satellites aren't already in your core. If your core is going to be an S&P 500 fund, maybe have your satellites actually play the part of being your international allocations. So overall, that was my easy to do portfolio fixes for many different common types of portfolios. If you've made it this far in the video, which, wow, thank you so much. I really appreciate it. I love making these types of videos and getting to practice kind of speaking on things I'm really passionate about. And I've also gotten some really good comments lately that have made me feel very, very good. So again, thank you very much. Again, if you have made it this far, please subscribe, and I look forward to seeing you in a future video. Thank you.